The recent White House directive to allow alternative investments such as cryptocurrencies and privately held companies in 401k plans introduces a host of new challenges for retirement savers. But here's where it gets controversial. While supporters argue these investments could yield higher returns, critics warn of increased risks and hidden costs. And this is the part most people miss: the potential legal pitfalls that could arise from including such assets in retirement accounts. In a market shock or prolonged downturn, these investments have yet to be tested, leaving many unsure of their true value. According to Christopher Bailey, Director of Retirement at Cerulli Associates, a leading asset management research firm, this is brand new territory. We haven't seen how these assets perform under stress. Proponents of alternative investments claim they offer the possibility of better returns compared to traditional retirement options. However, critics emphasize that these assets come with higher fees and less transparency. Philitza Hansen, head of product, equity, and fund administration at Allview Systems, a provider of software and solutions for private asset managers, points out the executive order raises more questions than answers. We need to carefully consider how to integrate these types of assets into 401k plans. Private equity and other alternative asset funds typically cater to wealthy individuals and institutions, often charging steep fees. For example, private equity firms frequently use a 2 and 20 model, where they take a 2% management fee plus 20% of any profits. This contrasts sharply with mutual funds, which typically charge an average of just 0.26%, as reported by the Investment Company Institute. If the executive order leads to a significant shift in available investment options within 401k plans, it could reverse the trend of reducing fees and minimizing risk that has dominated the financial industry over recent decades. Dimitri Katznelson, Deputy Chief Investment Officer at WealthSpire Advisors, which manages $30 billion for high-net-worth individuals, states, "It's going to take time to develop a framework that works and to fully understand the associated risks. For alternative asset managers to attract the trillions of dollars and 90 million investors in employer-sponsored retirement plans, they will need to create products with lower fees, greater liquidity, and improved transparency." Jason Kephart, an analyst at Morningstar, notes that some alternative investments have fees that are not clearly disclosed, making it difficult for investors to understand the full cost. Monitoring portfolio performance is another challenge. Traditional retirement funds allow daily tracking of investments, but private equity and other non-traded assets do not offer the same level of visibility. Allview's Hansen explains, "We're asking systems designed for daily trading to handle illiquid and manually priced assets, which creates a fundamental mismatch. This situation underscores the need for increased education and outreach from asset managers and plan sponsors. Investors who are not actively managing their portfolios may not fully grasp the implications of adding private assets." John Gray, President and Chief Operating Officer of Blackstone, suggests that private assets are more suitable for younger investors with longer investment horizons. A notable example of the legal risks involved in incorporating private investments into retirement plans is the case of Intel Corporation. Employees there filed a lawsuit against 2 retirement plans that included hedge funds, private equity, and commodities. After 7 years of litigation, an appeals court eventually dismissed the complaint. But legal experts note that asset managers and plan sponsors often lack the resources to handle such lengthy disputes. To implement Trump's plan effectively, regulators will need to provide the industry with legal protections against investor lawsuits. In conclusion, while the inclusion of alternative investments in 401k plans presents exciting opportunities for higher returns, it also brings significant risks and complexities. As investors navigate this new landscape, it's crucial to approach these changes with caution and a thorough understanding of the potential consequences. What do you think? Should 401k plans offer more alternative investment options, or do the risks outweigh the benefits?